Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, full coverage on the Fed as the central bank kicks off its rate-cutting cycle. Plus, Nvidia and Intel striking a deal. We'll break down what it means for both chip companies. And we get a read on the state of the consumer as Olive Garden parent Darden reports earnings. We'll break down those numbers. Plus, let's get a check of the markets right now. Taking a look at the major averages here a day after we had the beginning of what looks to be maybe a few cut cycle at least from the Federal Reserve. We see markets that are rising today. If we take a look at the Wi-Fi Interactive and the gains that we are seeing here, the Dow right now is up about 0.5%. I do want to look at the 2-day to get a look at what we saw yesterday in the wake of the Fed decision and the Fed press conference and then sort of how things played out. We did see kind of things coming down yesterday, now coming back up this morning. The S&P 500, similar action there on the day today. It is up about 0.5%, and the Nasdaq is leading gains up about 0.8% today. So a little bit of volatility following the Fed yesterday. It was broadly expected, of course, that the Fed would cut a quarter point, and then today coming back a little bit. Want to look at what's going on in the bond market as well to see how it is playing out there. Here's today's action with yields actually coming up now, even with the Fed cut. And looking at the 2-day, similar action there. We saw a decline in yields and then now that increase to some extent. But also wanted to dig in a little bit to what we're seeing move within stocks today. And of course, a large part of it is what's happening in large cap tech with the Nasdaq leading gains. We've got Nvidia up 2% on this agreement that we saw with Intel. Intel itself up by 25% here this morning. On the news, Nvidia is going to be investing $5 billion in the company, and they're going to be developing some new products together. So we're going to talk more about that in just a bit, but we're seeing other chip companies that are also on the rise today. TSM not on the rise, however, even though Foundry is not part of this Intel Nvidia agreement, Foundry being the manufacturer of chips. TSM, which is Nvidia's main manufacturing partner, is trading a little bit lower, but otherwise mostly green on the screen here. Let's zoom out now and talk about the Federal Reserve. The latest dot plot highlighting the growing division among FOMC members, with one member seeing the Fed hiking rates this year, another, who we can probably guess, seeing cuts of 1.25% over the next two meetings. Joining me now, Mohamed El-Erian, Queens College, Cambridge president. It's so good to have you here with us in the studio, Mohamed. And so I noticed you retweet a comment from Jim Bianco, another longtime Fed watcher and investor. And he basically said this meeting was a mess of this latest FOMC meeting in terms of the dispersion, not just of Fed rate cut forecasts, but of the economic forecast as well. Was it a mess?
And others have called it confusing. So there were two things. On the surface, we got exactly what we expected. We got a 25 basis points cut. We got a signal of 2 more cuts later this year. But once you go beyond that, it's really confused. The economic projections suggest something else. Higher inflation, higher growth. And that is not consistent with cuts. In fact, according to the projections, we're going to have 7 straight years where the Fed has missed its inflation target. Then go to what you just talked about, the interest rate picture. If you look over time, it's a dispersion, meaning the difference between the people up here and the people down here is so large that there's no forward guidance. So yes, we got a nice outcome with only one person dissenting. But if you go beyond that, as Jim rightly said, it's a mess.
So, but all of that said, do you think they arrived at the right conclusion for the action that they did, which was the quarter point cut?
I absolutely do. In fact, I think a quarter point cut was warranted in July. So I'm glad that they're starting the cutting cycle. I'm also glad that they are putting the emphasis on the employment side of the mandate. They are facing this very difficult situation, as we heard Gary say, where the economy is going away from them, both on the inflation side and the employment side. So they are deep in the world of second best, and they have to decide which of the risk is larger, and I think the employment risk is larger. So I like what they've produced. I just hate the fact that we don't get clarity and we don't get an anchor from the central bank. We need some anchor in this economy because otherwise it's going to get really complicated going forward.
What does that anchor need to look like? When you say anchor, what do you mean exactly? And what should they be changing?
So in the past, the central bank has always given us a vision of the future, where things were going. This central bank, after its big policy mistake in 2021, where it called inflation transitory, and as I said, we're going to end up at a minimum with 7 years above target, has become highly data dependent. So it's looking backwards. And as it looks backward, it doesn't give guidance to the marketplace, to businesses. And the problem with not having guidance from a central policymaker is that uncertainty goes up, and uncertainty discourages business from investing and could also discourage households from spending.
In their defense, isn't it a really difficult time to give that guidance? I mean, you know, you're in the economics profession. I've talked to so many economists over the past couple of years who have a new sort of source of humility because it's been very, very challenging to forecast what the economy is going to do. That said, of course, the Fed's supposed to be the best at this, right? They're supposed to know. So, but how can they possibly be forecasting in this kind of environment?
So we need them and others to have a transparent discussion on two things that really matter for all of us. One is, what should we expect for productivity? Will AI, life sciences, robotics, where we're seeing incredible innovation, will we get the diffusion through the economy that allows a significant increase in productivity? I believe so, okay, but we need to hear. And then the second thing, you heard that, the first thing wasn't even mentioned. Yes. The second thing, and we heard that in the press conference, is what's really happening in the labor market? Is it a supply issue or is it a demand issue?
Or both.
Or both. And how much of it is both? And how much it would last? That's really important. Chair Powell started saying it's this and then said, well, no, it's a bit of this. They need clarity on this. And I think that clarity is possible on this. But again, they're shying away. Now, I understand that on the enormous political attack, I understand that Chair Powell is coming to the end of his term. But if you don't have a policy anchor to this economy, the risk of volatility goes up, economic volatility, not market volatility. The market is happy to bet on the corporate side. The market is this very strange world where it says, I know the sovereign is messy. We have tariffs, we have central bank independence, we have high fiscal deficits, high debt. I know that's messy, but I'm happy to bet on the corporate side.
But is the Fed the real source of volatility on the corporate side, or is fiscal really, you know, our tariffs, our policies that, you know, sort of are very volatile themselves? Is that the real source of volatility for corporations?
So that's why we need the Fed even more, because on the administration side, they are attempting a major rewiring of the domestic economy and a major rewiring of the global economy. You need some anchor. I remember, I'm old enough to remember the early 80s when President Reagan came in and he undertook a major rewiring of the domestic economy. The Fed was there providing a very clear anchor as to where it was going. And you cannot have a situation where you have major uncertainty on the two greatest influences on the economy.
Now, you, a couple of months ago, made some waves by suggesting that Jay Powell should step down already.
On your show.
As head of the central bank. Exactly. We talked about it. You faced a lot of skepticism on that from various quarters. And now you're saying, even if he doesn't step down, there are certain changes he should be making now to put the Fed on better footing going into the leadership change. What changes should he be making?
So let's start with our discussion of July. At the time, I was worried that because of the tensions between the president and the chair, if Chair Powell didn't step down, the attacks on the Fed would multiply. And that is exactly what happened. And it is continuing to happen. And the reason why is very simple. The administration is looking for cause, a reason to fire Chair Powell. When you look at an institution, take a microscope to it, you will find something. And they are finding one thing after the other. And in the process, the objective of the administration is changing. Who would have thought in July that they would have their eye on the reappointment of the regional Fed presidents in February? But suddenly that's there. So what I was afraid of is happening. The other thing that's happening is now there's a massive understanding about something you and I have talked about before, is you need fundamental reforms to the Fed. You need greater accountability, you need greater transparency, and you need less groupthink. And we have really good examples of other central banks that have addressed these issues. The Bank of England, for example, has external members on the equivalent of the FOMC. And those external members guard against groupthink, because if you're within the Fed, the incentive to be in the herd and not question it.
Well, but at the same time, on the one hand, you have this huge dispersion in the dots, which we called sort of a messy meeting. On the other hand, you don't want groupthink. I mean, don't the dots illustrate that there isn't groupthink?
And that's the problem. People are saying, so let me get this right. We have dispersions and where we're going. We have inflation going up. We have growth going up. We have employment, according to the Fed, only peaking at 4.5% and coming back down, and yet we're cutting. You would have expected two-sided dissents. That's what you get at the Bank of England. We didn't. We got one dissent. In fact, one of the big surprises is we only got one dissent.
Right.
And I think it's important to understand what happens in a group dynamic, is that you tend to iterate and converge towards a view. And that, unfortunately, undermines the sort of cognitive diversity you need at turning points. There is a reason why the Fed has been consistently late, because they don't have the amount of cognitive diversity that they need to say what if. I thought Stephen Moran was really interesting when he said, I'm not the smartest in the room, but I'm willing to ask the questions that other people aren't willing to ask. And I think that the Fed needs more of that.
But a voice like Myron, or whoever ends up being the Trump-appointed nominee to replace Powell, how do you separate an earnest intellectual discussion from someone who is effectively a plant of the administration?
So look at the Bank of England. All the external appointees are people that have come either from economics or finance, that have come from outside the government, outside the central bank. It's understood they're going to serve 1 or 2 terms and go back to the outside. So they are technocrats. And then they join other people that have different backgrounds. And that's the whole point of cognitive diversity, is you bring different viewpoints. And it's really important. My career has shown that when you have different viewpoints in the room and you can talk about it in a safe area, you get better outcomes.
All right, well, we'll see if that happens. If there's any chance of that happening, especially before the turnover in the Fed chair. Mohamed, thanks so much for coming in.
Thanks for having me.
Really appreciate it. Coming up, we'll dive into the earnings report for Olive Garden's parent company, Darden. That's up next on Market Catalysts. Shares of Darden, the company behind Olive Garden, Longhorn Steakhouse, and others, is falling after missing Wall Street's estimates for first quarter earnings. Joining me now on these results, Gregory Frankfurt, Guggenheim Securities Senior Analyst. Greg, it's good to see you. I was struck by something that the company said on the call, that they are going to offer some smaller portions, lower priced entrees at Olive Garden. And I guess the emphasis right now is on value. Is that what's going on here?
Yeah, I think it's hard to know how much of that's value versus maybe the customer starting to ask for a little bit healthier portions, or at least some cohort of the customer base asking for healthier, smaller portions. But that was a lot of focus. I thought it was very interesting. Darden has underpriced the category substantially for the past 5 years, and casual dining has underpriced fast food substantially. And so that category has been winning on value, and it looks like Darden may be leaning in a little bit more.
So the healthier portion of this, is this the whole GLP-1 wave starting to show up here?
Yeah, CEO Rick Cardenas didn't necessarily mention that on the earnings call, but there definitely is some portion of the customer base that was asking for smaller portions. And look, Darden has won and is winning right now with their never-ending pasta bowl. They're running it for, I believe it's 12 weeks. Which is longer than it's been run in the past. They're winning on value, on abundance for price point, and it looks like they're trying to give the customer another option where maybe you can come and you could spend a little bit less, get a little bit less, and that's going to be a new thing they're trying here. Sort
of flexibility here. All of this said, that, as I mentioned, the stock is down because we saw comparable sales At Olive Garden, they were up 5.9%, which sounds pretty good, but is a little bit less, I guess, than consensus. Longhorn, similar numbers there. Do you think the numbers were disappointing, and if so, why?
Look, the overall comp beat by 30, 40 basis points. A lot of that was driven by the other businesses, which were the smaller brands. Cheddar's performed the best, which is one of their smaller brands. And Olive Garden and Longhorn missed what we were thinking by a little bit, 30, 40 basis points. So it wasn't massively different on the top line. Margins were, 30, 40 bips light of where we were expecting on labor and other costs. It just was kind of a little bit light across the board. And in this environment, restaurant stocks seem to be reacting a lot to small beats and misses.
Yeah, it's not just restaurant stocks. It seems to be happening in a lot of different areas, Greg. All of this said, you still recommend a buy on this company. Why? What do you think is still working, and do you think growth is going to reaccelerate a little bit?
Yeah, this has been one of the kind of preeminent operators in the restaurant space. They're growing units 3 to 4% on an annual basis. They're comping well. Even though they missed by a little bit, it was a high 4% same-store sales. That's a very impressive number. And it's trading at a discount to the S&P 500. So, you got a pretty good growth business trading at a discount, maybe with margins off a little bit here. But we would actually view that as responsible business investment for the long term. And we, as we've said, we recommend the shares.
We've talked a lot on the show about how higher income consumers are holding up better. But how are the fine dining concepts that Darden owns, how are they performing?
Yeah, they're performing worse, which is kind of
counterintuitive.
It's difficult. It doesn't make a lot of sense given what we're seeing with the performance of the consumer. I think you may have that upper middle income is kind of where you're seeing the most strength. Lower income's been soft for 2 years now. Middle income's gotten more soft in the last 6 months. And I think the middle of the higher income has been where you've seen strength. But yeah, it's weird that fine dining is as soft as it's been.
I think, what do I know? I'm not an analyst who covers it. I think of something like a Ruth's Chris, which they own, as maybe a splurge for a middle, lower income rather than a stalwart for an upper income. But I don't know. Is that the right way to think about it?
I think there's probably some truth to that. I think what you're seeing is that middle to higher income continue to kind of come in and go to casual dining restaurants. The restaurant industry category, the Darden shared, was up 5% on average. So and you have a lot of large quick service chains that are comping down 2, 3, 4, 5% right now. That has been the big theme in restaurants. Has been why are the fast food stocks or fast food revenue as soft as it is, and why is casual dining performing as well as it is, given the macro backdrop?
Yeah, I guess it's a bit of a conundrum. I want to ask you about another story that we've been watching very closely, and it's Cracker Barrel. I know you don't cover the stock specifically, but is there a lesson in here for the other restaurants? Obviously there was a big public backlash against them changing their logo. Do you think that other restaurant companies would be reluctant to do something like that after seeing what happened?
Look, I think most restaurants are trying to constantly reinvent themselves for younger consumers, for the next stage of food preference. And Cracker Barrel, I think, has been on that journey for a little bit of time. Why it became a lightning rod politically is difficult for me to know. But there's constantly. Let's go back to Darden. Darden kind of going with smaller portion sizing. They're trying to figure out what the consumer wants. They're trying to address it. Sometimes there's misses, and sometimes, but you're generally trying to have more wins than losses on that front.
Yes, for sure. Is there anyone in your coverage universe that could pick up some market share from a Cracker Barrel?
Yeah, look, there's a bunch of players that play in family dining. First Watch is one that we cover, and that kind of plays in the more daytime dining, breakfast and lunch occasion. Denny's does the same thing, with a little bit more of a broader appeal. But at the end of the day, it's a large industry. There's a lot of overlap with a lot of the traditional casual diners. Darden is probably one of the largest direct competitors in lunch and dinner for that day part. So there's a lot of sales out there, and it would probably get spread around if there was softness.
Greg, thanks for joining us. Appreciate it.
Thank you.
Coming up, diving into what today's deal announcement between Nvidia and Intel means for the chip makers and for the industry. We'll be right back. Shares of Intel are rising by over 20%, almost 30%, after Nvidia announced a $5 billion investment into the company to develop PC chips and data centers. Joining me now for more on this, Stacey Raskin, Bernstein Managing Director, Senior Analyst, longtime coverer and follower of this industry. Stacey, this was quite a surprise this morning, I think it is fair to say. What's your sort of first blush reaction?
I mean, look, so we've had a number of other, if you want to call them co-investments in Intel over the last few weeks. We had the big governmental investment for a little under $9 billion. We had the SoftBank investment for $2 billion. I think it's not, people were expecting that we might see others. I'd say with this one, it was surprising maybe for two reasons. One is the magnitude of the investment. $5 billion, at least for Intel, is a lot of money. Maybe not as much, it's not for Nvidia a lot of money, but for Intel a lot of money. And quite a bit bigger than, say, what we saw for SoftBank. And second, I think the nature of the other collaboration. I think a lot of folks have been hoping for a manufacturing or foundry partnership. This is not that. This is a product partnership, and I think it makes sense because there's Intel's process tech and their manufacturing flow is still up in the air. We don't know, but their product business needs actually a lot of help as well. I mean, they've been kind of bleeding share in a lot of other areas, and so. To the extent that, a partner like Nvidia, who is, big and important, to the extent that they can come in and maybe help Intel's product business, maybe that can help carry Intel along to the point where they can get the rest of the company together. But I don't know that people were expecting like a very significant product partnership. And that's actually what, at least at first glance, it looks like we have here today.
Well, and Stacey, I earlier talked to Pat Moorhead, another, longtime veteran chip analyst, and he pointed out NVIDIA's partnership, and partnership might be even too light of a word for its involvement with TSMC, its reliance on TSMC. Yeah. So, at some point, do you expect it to give some of its manufacturing to Intel? But how does it do that in a sort of delicate way, given the partnership with TSM?
I mean, look, no, TSMC is a fantastic company. Everybody relies on them, and that's part of the issue. Nobody likes to be single-sourced for these sorts of things. You want other sources. And there aren't really a lot of other options right now. There's only 3 companies that even in theory can do leading-edge manufacturing. It's TSMC, Samsung, and Intel, and mostly it's TSMC. So people do want second sources. I'd also say, just given the USA first kind of dynamic around the new administration, I mean, clearly there is a broader desire to do more in the U.S. And again, only one of those 3 companies is U.S. headquarters. That is Intel. Now, that being said, like there's not a lot that can happen, to force or encourage customers to use Intel's manufacturing because there's nothing to use yet. And I've made this point before. Nobody really needs to force or encourage customers to use Intel. If Intel can prove that they can make products in high volume that meet spec at a good cost that are available on time, that's table stakes for a foundry. But if they can prove they can do that, they'll have customers lined up around the block to use them. Like, I guarantee you, nobody will do TSMC partnerships or no. If Intel cannot prove that they can do that, no customer in their right mind would ever put any kind of meaningful volume at them. So it's on Intel to execute there. And we're not there yet. So I mean, like it's going to take a while. We'll have to see. In the meantime, though, I mean, if you can help Intel support the product business and improve the market share and the competitiveness of those products, that also brings more money and further competitiveness into the company, and maybe it helps them along that path as they are trying to get their manufacturing ducks in a row.
Does this open the door at all to a possible NVIDIA takeover of all of Intel?
I'm not going to speculate on. I've learned long ago never to speculate on AMD on M&A in the press. So I'm not going to even go.
Fair enough. Okay, so I'll ask you then what investors should do. I mean, you've got to market perform on Intel. Its challenges are well known. Does this investment, though, and not just this investment, but the investments, to your point, that we've seen over the past month or so, does that make a better case for getting into Intel here?
mean, look, this is clearly a positive for Intel for two reasons. Although I will say also, like, we don't know what the economics of this are going to look like either, right? It looks like they may be buying, chiplets from Nvidia. Like, I don't know what the margins will look like, but in general, I would say like the money is good. They could use the money. That's fine. And I'd say, having Jensen's blessing is probably priceless, right? So it's incremental. Now, is it 25% better for Intel? Like, I don't know, but it's clearly incrementally better for Intel. It's incrementally, positive for Nvidia. And you could argue about some of the others, like companies like AMD are down today because, like Intel competes with them. So is it, at least from a narrative standpoint, is it incrementally worse for AMD or some of the others? Like maybe, like that's possible. But this is a positive, development for Intel, like for sure.
Yeah, I was going to ask you about AMD and ARM as well, because those are the two that stick out to me as being lower as a result of this. Does it actually is it just perception, or do you think it's reality that it puts them at a disadvantage?
Well, like on the PC side, I mean, Intel will be developing presumably better chips. Like, call me in a few years. It'll take several years to develop that. But AMD's been doing pretty well, like on market share there, and so I mean, yeah, if Intel can develop more competitive products, that would be a positive for Intel's share and a negative for others. And then on the data center side, at this point, a lot of the CPUs that are actually going into the big Blackwell RAMs at this point are actually ARM based. They're Nvidia's own like Grace Blackwell chips. But there are some of those things that also ship with Intel processors and AMD processors. Again, if more of that volume, at least incrementally, is going to Intel, presumably it would be coming, at the expense of others, either AMD or ARM. Yeah.
It occurs to me as we're having this whole conversation, there's one word that hasn't come up in this conversation, and that word is China, right? This news has superseded the reports that about the anti-monopoly investigation from China, about them telling people.
That was yesterday.
I mean, that said, it doesn't seem like investors have been overly concerned about the China story for Nvidia.
Well, they have and they haven't. Nvidia stock was down, not a ton yesterday, but a little bit. But you have to remember, Nvidia took China out of their numbers.
Right.
So to the extent that they're not selling in China, at least there's no near-term revision risks from Nvidia. Now you could argue like the long-term strategic issues of Nvidia and even others, AMD, are not allowed to compete in China. There are other potentially broader strategic things that we could discuss, but at least in the very near to medium term, China's out of the numbers anyways. So to the extent that they're not selling into China or they're not allowed to sell in China, it prevents the opportunity for upside. But it's already out of the numbers, so You don't really have to worry that much about downside, at least for now.
Well, I'm sure we'll talk much more about that another time when we get more headlines. Stacey, thanks so much. Appreciate it.
Yeah, you bet.
Got much more markets action coming up. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Allie Canal, live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. Kicking things off with Nike, getting some love at RBC after the firm upgraded the stock to outperform with a new $90 price target, signaling about 25% upside from current levels. The analyst sees momentum building into 2026, pointing to product innovation, stronger marketing, and a boost from the 2026 FIFA World Cup, where Nike sponsors 6 of the top 10 ranked teams. RBC also said Nike's revenue underperformance against rivals like On and Hoka likely bottomed in 2025, setting up a beat and raise cycle ahead. Next up, Cracker Barrel. Shares still under pressure after disappointing earnings. Bank of America cut its price target to $42 a share from the prior $48 and reiterated an underperform rating on the stock. The call follows backlash over the chain's recent rebrand. Traffic dropped sharply after its new logo rollout and store prototype test, particularly among younger customers. Analysts also slashed earnings estimates for this year and next, warning that reduced capital spending won't be enough to offset weaker profits. Bottom line here, the turnaround is stalling and investors aren't buying in. Finally, rounding things out with Abercrombie & Fitch. Shares of the retailer are up after BTIG initiated coverage with a buy and $120 price target. The firm highlighted strong traffic trends, product catalysts like denim and boho Western styles, as well as potential multi-year growth at Hollister. As for competitor American Eagle, BTIG starts at neutral, saying that the recent run-up makes the stock less compelling until valuation cools off and sales visibility improves. We'll keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the session.
Now time for some of today's trending tickers. We are watching Nexstar and Disney, American Express, and CrowdStrike. First up, Nexstar and Disney. Disney pulling its late-night Jimmy Kimmel Live program after broadcast companies Nexstar and Sinclair said their affiliate stations would preempt the program following Kimmel's comments about Charlie Kirk's killing. Disney said it has not determined when the show might return to air. Kimmel said that those on the right were trying to profit politically from Kirk's death, and he mocked President Trump's grieving process, drawing criticism from Brendan Carr, the Federal Communications Commission chair. That, in turn, prompted Democratic lawmakers to call for Carr's resignation for, quote, corrupt abuse of power. Next up, American Express, the company boosting the annual fee for its Platinum credit card to $895. That's a $200 increase in price, but it's adding about $1,500 of potential perks to help customers get over the sticker shock. Benefits include $400 a year of dining credits at Resy restaurants, $300 to spend at Lululemon, and $200 toward the purchase of health-focused Oura rings. By the way, Lululemon shares are also getting a boost from that news. And finally, CrowdStrike. Those shares are jumping after the company held an investor briefing. CrowdStrike gave an update on its AI strategy and gave a preliminary outlook for its full year 2027. Analysts were positive on the view for its net annual recurring revenue. KeyBank noting the event demonstrated the company's strong position to secure agentic AI. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's Trending Tickers page. We've got much more markets action coming up. You're watching Market Catalysts.
Lyft shares soared in today's trade, rising 13% on the day. The company announcing a partnership with Waymo, launching a robo-taxi service in Nashville starting next year. Joining me now, we got David Risher, Lyft CEO. David, it is always great to see you on this show. So you announced this partnership, David, with Waymo, autonomous rides in Nashville. Great town, David, one of my favorites. But why Nashville? And is that just the beginning, David?
It is a great town. Hey, Josh, super fun. If you go to Nashville, you got to go to the Opry, as well as just sort of live the whole, bridal party life. But anyway, so no, look, super fun city, but also a tech-forward city, in a city that we've had a presence in for a long time. This deal does two things for our partnership with Waymo. First, it provides demand, right? We got millions of people every day who open up the Lyft app, and increasingly they're looking for an autonomous solution, which is great. And then second, it provides something called fleet management, which is what keeps the cars charged and ready to go. And this is something we've been doing for a decade, including in Nashville. So a lot of good reasons for it. It's also just, as you say, great city.
And let me ask you, David, what is going to sort of differentiate? What makes your partnership different than what Waymo has with your rival Uber?
Yeah, so I think it's two things. And again, I'll go to the same framework. On the demand side, we have something called integrated marketplace. It's kind of an integrated marketplace demand function, which sounds technical, but here's what it means. It means that we're taking these two fleets, all of Lyft's human-driven fleet and all of Waymo's, robot-driven fleet, and sort of putting them together in a very dynamic way. And without wanting to get too kind of technical on it, it means that rather than sort of thinking of these as two completely segregated things, where if you're on one app, you can only get to one. If you're on the other app, you can only get to the other. They're sort of dynamically integrated, 24/7. So it should mean, super fast pickup times for riders as well as high utilization. Which gets to the second point, fleet management. Fleet management sounds technical. Think of like what happens when you take an airplane. Okay, you get on the airplane, it's got to be ready to fly. It's got to be cleaned, it's got to be serviced, it's got to be fueled. Same with cars, right? They got to be ready to go. And we've had this fleet management subdivision for years now called FlexDrive. And that's what they do. No other rideshare service has it. Ours is integrated deeply into Lyft. We already have about 15,000 cars on the FlexDrive program. A guy named John Parks runs it, by the way. He's a Green Beret. He's freaking amazing at what he does. And what the goal is to keep the cars always, always, always ready to drive. And we think we'll be able to do that better than anybody else.
Now, you, David, you have other AV partnerships too, right? You got another one with May Mobility in Atlanta. Right. I know that's early days. Any line of sight you can offer there, David, about how that partnership is trending?
I mean, it's super early, as you said. We're just sort of an early pilot there, right down in Atlanta. But great so far, absolutely great so far. People really like AVs. And this is not at all to say that drivers won't have a huge, huge future in front of them as well. But it's great to have a new product that people find safe, find reliable. You know, it knows the traffic laws, it follows the laws. Of course, it's quiet and kind of private in the car. So these things are things that people, I think, are going to like for a long time. And it's why we think that AVs are going to expand the market, you know, wherever we go. We're actually seeing that in all the markets where we operate and AVs operate, is our markets are actually growing faster than they are elsewhere.
And so with those AV partnerships, David, how are you defining success? You know, walk me through, what are the criteria? What are the metrics you'd be watching?
Yeah. So the first thing, frankly, I'm going to be looking for over the long term is growth, right? We want this to be a new product that we can offer to as many riders as we possibly can. When you sort of click, you know, one down, we're trying to create something that hasn't been created yet, and it's called a hybrid marketplace, right? There are going to be human drivers and there are going to be robot drivers. And I want you as a rider to feel like I've got all the choice I want, and that no matter how I, you know, get a ride, the service level is always going to be super, super, super high. That's what we always aim for at Lyft. And then from sort of a financial side, of course, it has to work economically, not just for us, but for our partners, for the Waymos of the world. They've got to feel like it's a success for them. And again, a lot of that is going to come down to, are the cars ready to drive? And then is the utilization high? In other words, are people paying, and are the cars, you know, moving around with paying riders in it? So a combination of great business metrics, but also great customer experience, I think is going to grow the market hugely.
Finally, Dave, you know, we're always looking for line of sight into the consumer. You have that. I'm just curious, the consumer, you know, how healthy, how resilient does the consumer look, David, based on your business?
Yeah, we see strength. We see strength. And, you know I read the same headlines we all do, and everyone's looking for maybe areas of weakness. But if I look across, I look at commute, it still is incredibly strong. In fact, it continues to grow. I think return to office, frankly, continues to be a bit of a tailwind for us in a lot of parts of the country. But even leisure travel, you know, people going out for drinks or people taking, you know, airline trips, whether that's for business or for pleasure. Honestly, we see strength across the board. Doesn't mean things can't change, but at least from what we can tell, consumers pretty happy.
You know, David, I'll squeeze one in here. We did hear from the Fed today. There is some concern about a cooling labor market. When that happens, David, does that impact supply of Lyft drivers? Do you see more folks looking to come to you, looking to earn extra income?
It's a great question. And the answer is historically we have. Yeah, driver supply now is as high as it's ever been. And if I can brag for just a second, we have a 29-point advantage in driver preference over driving for the other guys. In other words, people who drive on both, when they talk to us, they say we like you 29 points better than the other guy. So, you know, anyone looking for, you know, a good way to bridge a gap or to come in and make extra money, I highly recommend driving on the Lyft platform. As you know, I do it too. But yeah, over time, what tends to happen is when the market maybe gets a little softer, it's a really easy way. 24 hours from now, if you've got a car and a good driving record or a safe driver and so forth, you can be driving on the platform. And it's a really important bridge for a lot of people, as well as a supplement if things get tough.
David, always great to see you. Thank you, sir.
Thank you, Josh. Been a pleasure.
Coming up this hour on Market Catalyst, first up, stocks resume their record run a day after the Federal Reserve cuts interest rates. We'll bring you analysis of what happens next. Plus, demand for AI means demand for energy. We'll continue our series today focusing on how that's playing out for next-generation power companies. And cybersecurity firm Netscope making its public debut. We'll go live to the NASDAQ to speak with the company's CEO. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. As I said, resuming the record run we've seen for the major averages, all three of them touching intraday highs today. The NASDAQ is leading because, yes, of course, you have the Federal Reserve and the reaction to that, but you also have Nvidia investing $5 billion in Intel and giving a lift to many of the semiconductor stocks. The S&P 500 up about 0.5%, and the Dow up about 120 points, about 0.25%. Well, indeed, stocks are hitting new highs today following the Federal Reserve's 25 basis point cut, with the committee also signaling 2 more cuts could come this year. Joining me now, Stephanie Roth, Wolfe Research Chief Economist, and John Hilsenrath, StoneX Senior Advisor. Thank you both for being here. Stephanie, I want to start with you because we had the quarter point cut as broadly expected. We have some more cuts now penciled in. What are you going to be watching most closely to figure out what is actually going to happen? Because as we know, the dot plot is merely a map, a plan. It's not a certainty.
Yeah, it's all going to come down to the labor market data. And does it prove that the labor market is largely holding up okay, which is our view, and perhaps that's what's feeding into bond yields rising today. We got the claims data. It still looks fine. Last week, jump in Texas appeared to be an aberration. So we're going to be watching the broad employment data to paint a mosaic of what's going on in terms of the labor market. And our sense is the labor market is okay, and we'll see potentially upward revisions to August in terms of non-farm payrolls. And then the trend in payrolls could look a lot better than what it currently looks at today.
So you got payrolls on the one side, maybe holding up all right. On the other side of the Fed's dual mandate, you have the inflation picture. And John, it feels like the view has really come around that maybe the tariff effect will not be that significant. That seems to be where perhaps the Fed is coming, no?
So yeah, I mean, I think this is one area where Fed Chairman Jerome Powell might be a little bit exposed, frankly. So if you look at the Fed's 2026 forecast, it's interesting because they have growth improving a little bit. They have the unemployment rate coming down a little bit, which suggests a hotter economy. And they also have inflation receding. So you say to yourself, how does that add up? How do you get less inflation when they think the economy is going to speed up a little bit next year? And really, one of the only explanations you come up with, which Jay Powell has said, is that they think that the effects of tariffs are going to fade very quickly. Frankly, I'm very skeptical of that. I think we went through 25 years of globalization that caused downward pressure on goods prices. We're now unwinding that. I don't see how that whole process plays out in 6 to 12 months. I think the Fed is exposed on their inflation forecasts.
Stephanie, what do you think?
I think it's fair. We'll see an environment where inflation is a lot stickier than certainly the forecast, and our expectation is it's going to be difficult for them to even cut 3 times this year and then again next year. It'll be an environment where the labor market is holding up a lot better and inflation is a bit stickier and sticky for a little bit longer. So we're talking about 3% inflation, let's just say, for a more prolonged period of time, certainly than their forecast, as John said, and certainly longer than Chair Powell kind of alluded to.
I'm curious what happens on the wage inflation front. Stephanie, I'll start with you on this, because if you have both a demand and a supply issue when it comes to labor, what then happens to wages?
Yeah, so wages could just be stuck around 3.5% to 4%, which is a quite healthy pace. So this is an environment where we are in this interesting equilibrium where both supply and demand has come down, as Powell talked about yesterday, and the steady state for the labor market might be largely in balance. An imbalanced labor market would tell you that wages should be somewhere between 3.5% and 4%, which then could just mean the consumer continues to spend and the downside risks to the economy start to abate.
But maybe still upside risks for inflation, John?
Well, I mean, I see some more tension points here. First of all, on the inflation story. So, yeah, okay, we might have 3%, but the Fed's objective is 2%. And we haven't been there now in 4 or 5 years. And the Fed's own forecast suggests we're not going to be back there for a couple of years. So I ask myself, at what time is the bond market going to say, all right, I'd like a little bit of more inflation premium because you haven't reached your goal in a long time and it's not clear you're going to. In terms of the wages, I'm a little bit concerned about how consumers are holding up, because let's say we get 3% wage growth. And by the way, wage growth has slowed a little bit as slack is disappearing in the job market. Real wages receded in July. And there's a risk that starts affecting consumer spending. Now, the last retail sales data looked like consumers are still hanging in there. And we know American consumers have this long history of resilience. But when the job market is slowing down and consumers, have some confidence issues, I just think it's a point you need to look out for.
Guys, we also have to talk about the dynamics within the Federal Reserve, right? And the fact that you had only one dissent. And the dissent, maybe predictably, was from Stephen Myron, who wanted a 0.5 point cut. You also have a big dispersion in the dots in terms of where we could see rates by year end. Stephanie, how does that inform then what we expect to happen with rates? Yes, there was that dispersion, but in the end, they, except for the one dissent, they all voted to just do the quarter point cut.
Yeah, which, by the way, is a positive sign of perhaps more durable central bank independence. But then beyond that, the question is, can they actually get the total of 3 cuts done this year? Our sense is no, that the labor market's going to largely hold up well enough such that they don't ultimately do all of them. Perhaps maybe at most they cut one more time. And by the way, it's a fairly divided set of FOMC members. So it's not as if it was a very easy decision. And they certainly didn't talk about 50 basis points outside of the one dissent. So it's going to be likely a backdrop where they're not going to do as much as what the median dot suggests.
And John, we earlier talked to Mohamed El-Erian last hour, and he talked about that he actually thinks there is too much groupthink on the Fed, and that actually has made them less effective. And one of the reasons why they have frequently been behind the curve. Because, yeah, you get the dispersion of dots, but then they all vote together for the most part. Do you think there's validity to that argument? Do you think there should be more sort of diverse voices on the Fed from different backgrounds?
Yeah, I mean, I think that's a fair point. And, the reaction to COVID was a pretty good example, which led the Fed right into a pretty bad mistake. So COVID happened in 2020, and the Fed took out the playbook from the financial crisis of 2008 and said, we got to throw all of these tools at this problem, zero interest rates, QE4, massive bond purchases, massive mortgage purchases. And, the Jay Powell led the group into what was pretty clearly a policy error. So I think it's fair to say, that there should be a diversity of opinion. There have been periods where opinion was diverse. I will say during the financial crisis in 2008 and 2009, Ben Bernanke was constantly dealing with regional, and this is the important point, he was constantly dealing with regional bank presidents who were saying, you're going too far, you're doing too much of this QE, you're going to cause inflation. And I think that's the argument for having 12 regional Fed bank presidents that are kind of independently chosen to a certain extent participate in this process. And so one of the questions becomes, do these regional bank presidents continue to have their own independence and their own involvement in this process as we go into a Trump-led Fed in 2026?
Lots of things to think about as we watch attempts to sort of remake the central bank. Thank you so much, guys. John, Stephanie, appreciate it. We got much more markets action coming up. You're watching Market Catalysts. Throughout the week, we've been speaking with CEOs and industry analysts on how booming AI demand has been fueling an energy transition. Today, we're honing in on AI and utilities. British renewable energy startup Octopus Energy is spinning off its artificial intelligence arm, Kraken, in what could create a standalone entity worth $15 billion, according to some estimates. Kraken has been key to Octopus Energy's growth into the UK's largest electricity supplier. Joining us for more, Kraken CEO Amir Orad here with us in the studio. Thanks for being here.
Thank you.
So you all have been preparing to spin off. Octopus is private. Kraken is going to be private. But I guess let's talk first of all about what you guys do. You're effectively a software company.
Pure software company.
And your software, though, helps route energy. Route electricity? Is that the right way to describe it?
If you think about it, we have utility companies, National Grid, for example, and they have endless infrastructure to run and operate their day-to-day. We modernize all of this infrastructure so they can handle modern energy needs, from EVs and solar panels to better customer service, to leverage AI to reduce costs, and everything in between, including routing some energy needs.
So I guess the difficulty with the modern, or one of the difficulties with the modern electrical grid, is that you have a lot of different inputs. You have, your fossil fuels in some cases. You have, whatever renewable energy sources are coming in. Mm-hmm. You have the output and the demand, which waxes and wanes. And you guys sort of sit in the middle.
Exactly right.
Figuring out when the demand is going up, where do you need to draw more from? Mm-hmm. Where do you need to draw less from? Is that?
If you think about it, what happened in the last decade, because we have different types of energy production, we have volatile production of energy, mainly solar, which is really cheap, but only during the day. We have batteries during the night. And the consumption, we have more EVs. At 7 p.m., we all plug them in. We have spikes. So both consumption and generation have spikes. And you want to flatten it to reduce cost. Otherwise, you spend on the infrastructure for peak seasons. So we're trying to flatten it on both sides, generation and consumption, and make sure we incentivize consumers to use the right energy at the right time, which is cheaper and cleaner, by the way.
And so your clients are the grid operators, as you mentioned, a national
big utilities,
grid.
yes.
And so what do you do by doing this separation? What does that achieve for you all?
Kraken already supports 70 million households worldwide. We just announced we're $500 million ARR, annual recurring revenue, already today. And what we found was, because we were born inside an energy company, some of the other energy companies were less comfortable working with someone that is potentially owned by their competitor. So number one, make that go away. So it's not really an issue, but it was a perceived issue. Make it go away. Number two, we're a pure software company. That's all we do, SaaS. We can run independently, running as a SaaS company with SaaS board, SaaS metrics, et cetera, et cetera. And because we're growing really fast, that support system allows us to create optionality of buying other software companies, being able to have our own currency, et cetera, et cetera.
Is there anybody else who's doing, I mean, what are your main competitors in this area?
So the two best companies in the space have been SAP and Oracle, which are really great companies, but 20 years older. And their infrastructure, their architecture was very rigid and very limited. We're leveraging AI, cloud, data-driven decisions. We actually process already, every day, 15 billion data points to optimize the grid, optimize demand, et cetera, et cetera. So we replace actually those SAP, Oracle, Salesforce, IBM technologies with one platform, replacing 20 to 30 small systems that is all connected on the cloud, AI data-driven.
I think about the example of Texas, where you've had several years where you've had heat waves, you've had brownouts. Does something like this manage for that? But there's also been a lot of talk about grid updates, physical infrastructure updates. So how does that all play into what?
So the two are not mutually exclusive. First, Texas is very unique because, as you would not expect, Texas is actually the number one deployer of renewables, solar, in the US. Why? Because it's cheap and accessible. That's like a very simple view, especially in Texas. If you have all of that solar, you have peaks during the day and valleys during the night. You need some technology to normalize it, what we call flexibility. So we already operate in Texas with one utility, but you can help rationalize and leverage better all of these investments. As you do more of that, you will need to spend less modernizing the rest of the grid. We still need to modernize it. It's old. We have to do it. But we can spend less on it if we optimize it with technology and if we reduce the peaks, because the grid is really built for the peaks. We build this massive highway for the one time during the day there's this big traffic jam, and you can do better.
Is the biggest opportunity in the US, or do you also see it around the globe?
So we're very global. We have customers from Australia to Japan, Germany, France, UK. 50% of all the UK households run on Kraken. The US is a really big market. Today, Europe is ahead of the US because of the incentive systems and the competitive nature of the market, but the US is catching up really fast. It will be a big market, not the biggest market.
You mentioned as you do the spinoff, one of the things you might do is add other software companies. What kind of capabilities or categories would you be looking at?
So one of the unique things about Kraken, we're only focused on utilities and de facto only focused on energy. There's a lot of really smart startups with really unique algorithms that are very powerful, but to get them into a utility can take a decade. To integrate it with all the other systems will take forever. We can help them accelerate time to market and have a bigger impact on the grid, which is what we want as consumers. As we own households, we want electricity that is safe, reliable, cheap. That can help.
We came into this by saying that AI is a big part of this changing face of energy demand. How does that feed into what you all do?
So it's amazing. AI is literally on both sides of the aisle.
Right.
AI is the new factories or data centers. And people are building more factories called data centers every day, which need more electricity. That's on one side. On the other side, AI can optimize the grid much better. Those 15 billion data points, I don't know how many humans are needed to calculate them. You need machinery, you need AI, and you get the benefits of that. So it's both increasing load and helping optimize the grid.
And then also, I've seen it in my own bill. Electricity costs have been going up, in part because of demand for AI, but also just general demand. Yeah. Are you going to help me make my electricity bill go down?
When deployed correctly, Kraken allows you, and we've seen it, reduce costs for the utility. That money can be shared with consumers. For example, if you own an EV, most of our clients today have schemes where they, with Kraken, manage when the EV will be charged during the night. We commit that when you wake up, you have enough gas or electricity, but by doing it at 2:30 a.m. and not 8:30 p.m., we can cut your costs almost by half. And we save the grid cost because we find extra capacity. So that's a direct example that your cost will go down.
Mm-hmm. And then finally, so you're doing this spin from a private company, plans to go public?
So the first plan is to have an amazing private company that does well. We're there today, scaling fast. We grew in the last 3 years 4x, in the last 3 years. So there's a lot of need out there. Once we're independent, obviously it creates optionality and we can do more.
All right, Amir, thank you so much for coming in. Really
Thank
interesting
you.
stuff. Appreciate it. We got much more coming up. Action on the markets, trending tickers. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Ali Canal, live at the NASDAQ. Let's get a quick check on the market action about 2 hours into the trading day. And you are going to see green across your screen here. The Dow is up 130 points. The NASDAQ leading the way higher, up a whopping 1.2%. I will get to the reason why in just a second. And the S&P 500 up roughly 0.6%. Now, what's helping the NASDAQ, if we take a look under the hood of the NASDAQ 100, is Nvidia. We're seeing shares rising well over 3%. And this comes after Nvidia announced it will be investing $5 billion in Intel, taking about a 4% stake and partnering to build new AI chips for data centers and PCs. Intel shares are up nearly 30% on that news. Looking at a 2-day, you see that pop right there. Meanwhile, AMD shares, they're down roughly 3%. And AMD is a competitor here, a rival to these companies. Investors seeing this deal between Nvidia and Intel as a threat to AMD's core markets in PCs and data centers. So the chip companies firmly in focus today, overshadowing that Fed news we saw on Wednesday a bit, with the central bank delivering its first rate cut of 2025. If we take a look at some of the reaction in the bond market, you're seeing a bit of selling pressure. The 10-year yield is up 5 basis points. The 30-year yield up around 6 basis points. And investors had already priced in that 25 basis point cut heading into the Fed meeting. Inflation remains sticky, and the Fed also signaled more caution when it comes to future rate cuts. So the bond markets perhaps demanding more return. We also saw some reaction in the U.S. dollar index. Now, year to date, this index has broadly struggled. However, we were able to bounce off those 3.5-year lows and trade just a bit higher following that Fed cut. But as you can see, we are down almost 11% in the U.S. dollar index, currently trading right around the 97 level. And finally, let's take a look at Bitcoin, because Bitcoin prices also on the move, up around 25% year to date. If we take a look at a 2-day, you're going to see that spike after the Fed cut interest rates. We are now firmly above $117,000 a coin. Strategists say the next technical levels to watch are Bitcoin prices hitting 118 to 120,000. If that happens, we could see some more momentum there for the largest crypto. But keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the session.
Now time for some of today's trending tickers. We are watching Cracker Barrel, Ticketmaster, and Live Nation, and semiconductor stocks. First up, Cracker Barrel. The company reporting earnings for the first time since its logo fiasco. Joining us for more, Yahoo Finance's Brooke DePalma. Of course, we're referring to the situation where it said it was going to change its logo. There was a big backlash against changing the logo. Then it said, no, never mind, we're not going to change it after all. Well, how did all that translate into sales for the company?
Yeah, well, what we saw in this past quarterly report is ultimately this quarter did end on August 1st. And so they didn't really get an exact take on how exactly this hubbub, all this drama of the back and forth, the pull of the designs, the reverting to the former design actually ended up going. But that happened on August 19th when they officially introduced introduced that logo. And what we did hear on the call was that ultimately what led them to really cut this outlook was because they did say that in the first half of August, they did see traffic that had been down about 1%. And then after that logo change was announced on August 19th, they did see traffic decline approximately 8% since then. And so ultimately that led to the company to say that they expect a traffic decline between 4% to 7% for fiscal year 2026. Keep in mind that the way the Cracker Barrel reports, they're already in fiscal year 2026. And so the current fiasco that's going on is the first quarter of their next fiscal year already.
Gotcha. I mean, I never thought that much about corporate logos of places where I eat out, but I guess a lot of people do.
A lot of people do, absolutely.
Right.
And it definitely hit their younger consumer, which they've been trying to get as well.
All right, let's talk about Ticketmaster and Live Nation now. The FTC and 7 states sued Live Nation and Ticketmaster for failing to stem the use of automated ticketing bots and large-scale resale operations. The shares of Live Nation down about 2.2%. And this is not a surprise necessarily, because the administration has been talking about, Congress has been investigating, all of this has been leading up to this.
Yeah, certainly leading up to this. And in some, anecdotes that we're getting this morning saying that a settlement's also possible here right now. This is particular between Ticketmaster and Live Nation. They did say that Live Nation could be on the hook for billions of dollars as the law allows potential penalties of $53,000 per violation. So really we are seeing that stock dip just a bit based on this news. It did dip lower upon the initial announcement of this FTC investigations here as well. But year to date, Live Nation has been doing well. There is still a lot of bulls on the street when it comes to the support, or rather ratings for buys. There's 19 buys, there's 3 holds, and just 2 sells. And this company year to date is up about 27.5%. And so despite this noise in the background that's surrounding the company, this ultimately has gotten a lot of rhetoric for the potential outlook on the street. I'm reading a note right now from CFRA, and they said that concert touring ecosystem changed and scales matters. And well, this also plays into the investigation here. There's no other competitor really to Live Nation. And that's where we're hearing a lot of this background noise as well.
Yeah, I mean, there are some other ticketing platforms here and there. StubHub also just went public, although it's mostly secondary ticketing that it does. And there's also the question of if Ticketmaster does eliminate the bots or successfully cut down the bots, it'll still have majority market share, presumably. Mm-hmm. So we'll see how all of this plays out. It's a fascinating story, though.
Yeah, and I feel like the retention was really broad when people tried to get those Taylor Swift tickets.
Well, I was just talking in the break to the CEO guest we just had on a few moments ago. He was trying to get Taylor Swift for his daughter's 17th birthday, ended up having to get tickets in Chicago instead of New York, had to get it on a secondary platform. As we know, those tickets were very, very pricey.
Very pricey.
So that's set off.
But hey, that played into the whole people traveling, the ecosystem, the boom to the economy, all because of Taylor Swift, and now we're even hearing it once again in this today.
We are. All right, we'll see how it plays out. And then finally, let's talk about chip stocks, because ETFs in the space are outperforming after the Nvidia-Intel deal. Of course, Nvidia, the announcement this morning that it was going to invest $5 billion in Intel, and the two are going to develop CPUs together. You can see the VanEck Semiconductor ETFs, SMH, which we use to track the industry, is up 4.2%. And the trending tickers page here at Yahoo Finance is just littered with companies that are sort of tangentially related to this.
Absolutely. We see AMD, we're down about nearly 3%. We have Strategy down more than 6%. We also do have others as well, also trending. But really, when you think about that SMH ticker right there, that includes Nvidia, Taiwan Semiconductor, it includes Broadcom, AMD, Micron. And so really all these companies have really outperformed once again this year. And now we're seeing the back tail of that news on Nvidia-Intel deal here once again playing into that.
Yeah, you also have, kind of other things helping out matters here. You had the announcement that Microsoft was increasing an investment in data centers in Wisconsin, I think, to $7 billion. So this sort of waxing and waning of the AI spending, what's the cadence of it? And so today you have it on the upswing. I also noticed Synopsys shares are trending. That's the chip design software company that counts Nvidia among one of its biggest clients. So it too is getting a boost today.
Yeah, and if I'm looking at the semiconductor stocks on our YF Interactive, we do have that mostly in the green today. And Intel, of course, leading that charge is up nearly 29% just today alone. Year to date, this company has certainly seen a roller coaster of investor response based upon honestly what's happening with its relationship with the Trump administration, the investments that it's getting and the support that it's getting there. Now on top of that, we're hearing that Nvidia also investing in the company, but really mostly in the green. We have AMD and ARM down today and Broadcom just up ever so slightly, up about 0.7%.
Concerned that they might have the most to lose from this partnership, but we'll see how it plays out. Thanks, Brooke. Appreciate it. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, retailers are looking to get ahead of the holiday rush, importing products they usually put on sale later in the year, about a month early, to avoid any additional tariff costs. That's according to the Port of Los Angeles Executive Director Gene Soroka. Well, because of this pull forward, Soroka says he expects volumes through year end to be softer, with September imports likely falling 10% from 2024. For more insight into how the supply chain is adjusting to tariff policies, we've got Michael Goldman, the North American GM at Carew Containers. The company supplies used shipping containers to storage and logistics wholesalers around the world. North America is the largest and most important market. So just give me sort of a reading on what you're seeing in terms of demand and how it has changed during this whole tariff back and forth, Michael.
Sure, absolutely. Thanks for having me, Julie. I think you really hit the nail on the head there with your intro. With that, we had a lot of disruption in the market with new tariff policies from the new administration coming in. And when things were uncertain and before tariffs had really been implemented, you had a lot of importers sitting on the sidelines, kind of waiting to see what was actually going to come to fruition. And then what we had is we had some delays on the tariff implementation, and that really got importers off the couch and really front loading their imports for holiday season and back to school season earlier than expected. We had a couple delays in the tariff implementations, and so that caused a lot of front loading. And just like Gene from the Port of Long Beach was saying, is that now wholesaler inventories are quite high, and there's not a huge demand for importers to bring in more inventory at this point.
And so are you seeing another sort of lull, and is that unusual at this time of year, considering we're something like 100 days till Christmas?
Well, it's certainly a little bit of a lull right now, but as we've seen in the shipping industry, especially since COVID, it's a market based on disruptions in a large part. Disruptions can come at any time, at any moment. I'm not an importer myself. That's not exactly our business, but if I was, I think importers really need to be ready for the market to change on a dime. Right now, things are a little bit quiet because there was so much front loading leading up to summer. Right now it's a little quieter, but that could really change at any moment due to any type of geopolitical event or anything like that. The good thing is that our shelves are full. We have all our back to school supplies that we need, and it's looking like all the Christmas presents we're looking to buy, they'll be on the shelves as well.
We know that, there's a lot of different ways that companies have been dealing with the tariffs in terms of whether they're changing their supply chain, whether they're trying to be more efficient in their factories, whether they're passing on those costs. What has it meant for you business? Have you guys raised your prices, for example, or are you under pressure to keep them not high because your customers are feeling some of that strain?
Well, I think it's a really interesting question. I think it's a really interesting question that a lot of businesses are looking at right now. I think the policy of the current administration has been so back and forth that it's really difficult for businesses to really pick a big way forward and stick to it. So just like most other businesses, we're kind of taking the information as it comes and dealing with it that way. And that's really the best we can do for right now. I think every business really cares a lot about their customers, and the last thing you want to do is pass along a price increase, but also sometimes if the cost basis dictates it, then sometimes you don't have a choice. We have a lot of businesses that are affected by tariffs. A lot of these businesses have very different margin structures. So I'm sure it's a very big mosaic of businesses. Some do have to assess something on their selling prices. Some businesses are probably able to absorb a lot of it. But I think the most interesting dynamic that I think our country, our businesses, and our citizens should kind of be aware of is that there's no quick answer for what's going to happen with the new policies. And I think there's been a lot of talk this year about how, oh, well, economic numbers have been good. They keep coming in good. I think this is the type of dynamic that's a little bit bigger than just being able to follow it on a monthly basis, say the numbers look good, and say there's been no effect. I think that we really haven't seen the full effect of these new policies, these new tariffs yet. And so I think we're going to have to wait a little bit longer to really see the full effect of what it has on retail pricing.
So what happens now then? What's the best guess as to when that does start to show up and how much it shows up?
Yeah, I think it's definitely going to be different for every industry. I think some industries really have the ability to absorb a lot of these tariffs. And I think that some industries are not going to have the ability to absorb a lot of these tariffs. I also think it's fair to say that businesses don't create revenue or margin out of nowhere. So if something comes in to take a piece of that margin or revenue, there's a lot of ways businesses will think of how to recoup that, especially if they absolutely need to. But I think that's going to depend a lot about how our tariff policy gets finalized in the near future.
Or maybe not the near future. Maybe we'll have to wait longer. We'll see. Michael, thanks a lot. Appreciate it.
Thank you.
We got much more markets action coming up. You're watching Market Catalysts.
The job market is especially tough for recent college graduates right now, but a new study is showing the cities where hiring is happening. JLL's latest Talent Hubs report finds graduates are getting jobs in big cities like New York and San Francisco, while Sunbelt cities like Dallas are climbing in the rankings. Joining us now for more, we have John Gates, JLL America's CEO of Leasing Advisory. John, it's good to see you. So the report here, we're looking at cities attracting those new graduates. Before we get to the actual cities, and I want to run those by you, John, what are the big drivers here that you saw for Talent Hub growth?
First of all, thank you very much for having me, Josh. Glad to be here. The big drivers, we've seen a meaningful uptick in venture cap investments and spending, and you have a couple big hubs, Northern California, obviously, and then New York has become a very large hub for that. And so you see sort of small cap and mid cap tech job growth, which has been big. The financials have been hiring. And so we've just seen an improved environment overall for college graduates, although very recently it's slowed a little bit.
Let's get into some of these cities, John. Let's see who makes the list. So it looks like your report shows San Francisco jumping back. It looks like, John, to the number 2 talent hub. What is driving that, John, and is it sustainable?
Well, I think it probably is sustainable for some period of time, although tech certainly is volatile. That is AI growth. The venture caps are funding a lot of new startups. You're seeing, B and C rounds, and just so there's job growth there and exciting activity. And I think that's an exciting space for young people as well, getting out of college. And obviously, you've got a lot of universities on the West Coast. The other thing I would throw in is it's young people getting out of school have wanted to go to large cities to start their careers for a long time. They now have an opportunity to because there are jobs available.
Here's another one I want you to take on, John. Dallas, Fort Worth. It looks like John, it's been the top corporate relocation destination for 5 years running. What explains that trend?
Texas is a pro-business state. It's a reasonable cost of living state. It's a low tax environment state. And so, yes, we've seen many corporate relocations, small mid-cap businesses and Fortune 500 companies have moved here. And then beyond the headquarters relocations, I'm sure you've seen the Y'all Street phenomena, if you will, where large financials have been moving very large numbers of jobs here as well, although probably not headquarters. So we have been the beneficiary. I live and work out of Dallas. We've been the beneficiary of tremendous high quality job growth here. And I think it's for typical, business fundamentals, high quality labor here as well.
What has it meant for real estate demand in that area, John, specifically?
It's been very good in the office market at the top end of the market. All these jobs and companies that are coming here generally want newer office stock that's very well located. And as you would know, Josh, very highly amenitized. So lots of things to do to make the building seem intriguing and exciting, street level activity and plenty of places you could walk to. It's the same things we're seeing in other big cities as well. Dallas, again, throws in the quality labor at a reasonable price point, quality housing, quality education, low taxation, low regulation.
Any kind of, let's say, relatively affordable markets, John, you'd have your eye on that could maybe break into the top 10?
Well, I still think you see expansion across the South. There just tend to be more affordable than the urban densities in the northern half of the United States. So I think Raleigh, Durham is one. Charlotte continues to grow. Atlanta's not exactly a sneaky market, but I think a lot of growth there. Nashville, Phoenix continues to grow. Austin. So I don't know that I have a news story there for you, but a continuation of a story that's been happening for a little while here.
Well, if you were to look at this report, John talked about what it means for different groups, for investors who are listing, what would be the big takeaways?
Well, if I was a real estate investor, then I would be looking at markets that have positive net absorption and leasing growth. And it tracks very closely with those. New York has been very strong for the last 2 years. Northern California had a dramatic increase, especially in the city, starting last year, and it's continued this year. Dallas has done well this year. And so that's a good place. Probably office is an out of favor asset class for sure because of the flight to quality, and maybe there's a real opportunity there.
Finally, John, given your area of expertise, I got to get your take on the Fed decision today. What'd you make of what you saw and heard?
I think down the middle of the fairway, it's what we expected. I would have been a little more surprised by a larger move at this point. That this Fed has shown us that they will be methodical, I guess, and somewhat conservative and not bold in making big decisions. So I think it was about what we expected.
John, always good to see you. Thank you.
Great to see you. Thanks again for having me.
Some breaking news crossing the wire. President Donald Trump has asked the U.S. Supreme Court to let him oust Federal Reserve Governor Lisa Cook while the legal fight over her firing proceeds. The request pulls the justices into the battle over the central bank's independence. The Justice Department asked the court to at least temporarily pause a federal judge's ruling that had allowed Cook to remain in her position for now. Earlier this week, a divided appeals court in Washington affirmed that Cook can continue working while her lawsuit challenging Trump's move to dismiss her proceeds. The 2-1 ruling came just hours before Tuesday's start of the Fed's highly anticipated two-day meeting to vote on interest rates. Remember, Cook sued Trump last month after the president moved to oust her over allegations of mortgage fraud, which she denies. The lawsuit has emerged as a major flashpoint in the growing clash between the White House and the Fed, which has resisted Trump's demands to lower interest rates. Cybersecurity firm Netscope is set to make its public debut this morning. The company's IPO was priced at $19 a share and raised just over $900 million. The company valued at $7.2 billion and counts Excel and Lightspeed venture partners among its backers. Joining me now from the NASDAQ is Sanjay Berry, Netscope co-founder and CEO. Sanjay, thanks for being here. Congrats on the IPO.
Thank you, and thanks for having me.
So
appreciate it. It's an exciting day.
It is an exciting day. There's a lot of cybersecurity companies out there, publicly traded and privately held. What is Netscope's special sauce? What makes you all different from other cybersecurity providers?
Yeah, if you look at what Netscope does, it redefines what's the biggest market in security, data and network security. And our whole purpose of the company is to let people say yes to cloud and AI. So instead of saying, no, you can't use ChatGPT, or yes, you can, and you worry about what happens with it, we give you the ability to say yes and put guardrails. You can use it, but you can't use it to query with sensitive data. So it's how in this modern world can I use cloud and AI in a secure way? That's ultimately what Netscope does.
So it's almost then a sort of filter on these kinds of chatbots?
Yeah, so think about 100,000 plus SaaS apps in the world, tens of thousands of AI and generative AI apps, billions of websites, many tens of thousands of applications customers, enterprises have built. We look at all of those. So as people access them in a company, we sell to organizations, we look at that traffic and say, well, okay, that is valid. This other part, where you're trying to, for example, take corporate data and put it in your personal Dropbox account, that's not allowed. You're sending Gemini something that says reformat this healthcare data, and it's a public LLM. You can't do that. And so it's around how do I let people in a company use the tools they want, yet protect the company from their data and protect against threats.
I'm curious, as AI evolves and more companies end up using more tailored models, right, or proprietary models, or software companies that provide agentic AI services, what role do you all then play in that kind of a scenario?
Yeah, absolutely. So for us, if you look at, we run one of the world's largest cloud networks, right? We have companies that are 500,000 users. All their traffic goes through us. You open your laptop, you take your phone out, you go to your office, that traffic goes through us. And we enable it and secure it and accelerate it. And so instead of just humans, what I foresee in the future is that over half of the traffic going to the internet will come from non-humans. It'll come from AI agents. It'll come from devices. And so the same thing that we have done for users, we are now doing for those, for AI agents, for devices. Make sure that they're communicating with only the right things, only with the right data, so that you protect the company. So
it's interesting, the timing of the IPO. We've seen the IPO windows finally kind of open up here. We've seen a handful of different offerings in the past couple of months, and things start to re-accelerate. So what do you all hope to achieve by doing it at this point in time? What are you planning to use the proceeds for?
Yeah, it's a great question. So just, as backdrop, I'll be here in 15 years. And so we have a philosophy at Netscope, go long, right? Don't just think about the quarter, think about what's happening in 3 or 5 years, skate to where the puck's going. And so in that landscape, when we think about going public, for us, it's awareness. We know that if we can get into a customer and they see what our platform does, they're gonna more often than not, 80+% of the time, buy it and they want it. But we need the awareness. We need the at-bats. Being public brings us that. It brings us the ability for these companies to instantly see, okay, Netscope, big player, 30% of the Fortune 100, 18% of Global 2000, solid company. And so it brings you that cred, it brings you that awareness. And for us, that is the single biggest reason that we're going public.
Sanjay, I got to ask you the question that I ask everybody who's coming public, which is, when are you guys going to turn a profit? Because as you said, you've been there a while, you've got playing the long game, but you guys are still not profitable. When might that happen?
So just, if you take a step back, we are cash flow positive. And you've seen our margins inflect as well to the mid-70s. We had 20+ points of operating margin improvement. And so it'll follow. With hitting cash flow positive now, our operating margin will follow. We have a durable long model. We just put a massive amount on our balance sheet as a cash flow company. And so it's a great thing for us, and the op margin will follow.
Do you have any idea when?
We're not giving guidance right now. Mm-hmm. So that's one of the things about being public. you have to wait. And so perhaps later.
Okay, thank you so much, Sanjay. Appreciate it, and congrats again on the IPO. That's it.
I really appreciate it. Thanks for having us on.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.